Yo, what up, doe? It's Langston Hughes, and welcome back to Epic FX. Today, I'm going to give you guys a real treat. This is going to take your trading to the next level, and you'll be able to look at the charts in a way that you haven't been able to do so before. One of the most misunderstood but vital components of trading is market structure. And today we're going to be covering market structure. So what is market structure? Market structure is simply a way to categorize price. Sometimes we have an uptrend, sometimes we have a downtrend, and sometimes, quite often, we have consolidation, or what is known as a range or a ranging market. So with no further ado, let's hop right into it.
Fingers down my spine. Girl, you look mighty fine. Won't you rub your fingers down my spine? Girl, you look mighty fine. Won't you rub your fingers down my spine?
Let's look at uptrend. In an uptrend, price will form a pattern making higher highs and higher lows. We have a low here and a high here. Price pulls back and reverses at this point, making a higher low than the previous low. It then pushes up further, giving us a higher high. This swing high is higher than the previous high. These price moves to the upside are called impulses, and the smaller price moves to the downside are called pullbacks. When an impulse move ends and a pullback begins, these turning points will give us our swing highs. When a pullback ends and the next impulse begins, this gives us our swing lows. It's quite common to see previous swing highs in an uptrend form a level of support. When price pulls back into support, it will often reverse and swing higher. This is the basic market structure of an uptrend. Let's look at an example on the 4-hour chart. This is our initial swing low. We have an impulse move to the upside, which forms the swing high. We then see a pullback and prices hits this area before reversing. This is our higher low because this swing low is higher than the previous swing low down here. We have another impulse move to the upside, breaking the previous swing high and forming a new swing high. This is a higher high because it's higher than the previous swing high. This is the start of a basic uptrend. We have a low, a high, a higher low, and a higher high. Remember what I said earlier about previous swing highs forming a level of support? That's what's happening in this example. Drawing a level from the previous swing high further out in time, look how price responds to it. This level acted as support. So what happened after this next higher high was formed? We pulled back into support and formed a higher low. This swing low is higher than the previous swing low. After that, price moves up further with another impulse move forming a higher high. This swing high is higher than the previous swing high. And if we draw a level of support further out in time from the previous swing high, we can see price bounce off this level and continued higher. Downtrend. For a downtrend, you will see similar price movements but in reverse. Price will form a pattern of lower highs and lower lows. Here's the initial swing high. We have an impulse move down which forms our lower low. We see a pullback and price hits this area before reversing. This is a lower high because this swing high is lower than the previous swing high. We see another impulse move down and another pullback. So we have a high, a low, a lower high, and a lower low. Now if we draw a level at this swing low and extend it further out in time, you'll notice it acts as resistance when price pulls back into that level before continuing down. We have a lower low form, and once again we see price pull back into the resistance that was formed at the previous swing low. Consolidation. The last kind of price movement is consolidation. This is when price is neither in an uptrend nor a downtrend, and price is moving back and forth between a level of support and resistance. You'll notice that we have a level of resistance above that rejected price, and we have a level of support below that rejected price. We have a swing high and swing low on the left, and price has been unable to create a higher high or higher low. This kind of price movement is very different to both the uptrend or downtrend. Price is not moving in one direction, rather it's moving both up and down or even sideways within the range of support and resistance. Eventually price will break outside of the range and often return to test the upper or lower range boundary. If price breaks out to the upside, it will often come back to retest the upper side of the range boundary before continuing in an uptrend. And if price breaks out to the downside, it will often come back to retest the lower side of the range boundary before continuing in a downtrend.
And there you have it, market structure. Now you should be ready to take your trading to a whole new level. There's nothing like market structure when it comes to identifying the prediction of price. So don't forget to like, subscribe, and leave a comment. Let me know if this was helpful for you. Until next time, peace.